Welcome to Market Catalysts. I'm Julie Hyman. It's a big day for the markets. We've got the release of the January jobs report, but we're also keeping an eye on earnings. And so let's dive right into Ford. Ford is edging higher despite reporting a fourth quarter earnings miss. Actually, now the shares are edging lower, but the company does see a rebound in profit following a $900 million tariff hit that was a bit of a surprise. Itai Micheli is joining me. He's an equity analyst at TD Cowen who covers the stock. Itai, this felt like sort of a noisy report, right? You had the tariff thing, you had some other items. So how do you sort of push that aside and figure out how Ford is actually doing?
Yeah, well, thank you for having me. You're right, it was a noisy quarter, both with some tariff timing issues and the continued recovery from the Novelis fire. But the underlying results, both for Q4, the 2026 outlook, and even beyond, to us were pretty encouraging. If you remove some of the tariff timing issue in Q4, Ford would have beat, including on cost. And remember that Ford has been a cost execution story for quite some time. So great to kind of see them execute better than expected in Q4. And the 2026 outlook was in line with consensus at the midpoint, though that also included some non-repeating Novelis items that suggest a stronger underlying earnings rate than what the street kind of had coming in. And lastly, the company also provided 2029 margin target of about 8%, which supports a much higher earnings power going forward. So we were actually pretty encouraged with the results last night.
I want to ask a little bit more about Novelis, which is the company's aluminum supplier. What you're referring to is they had a big fire at their facility in New York. They're closed for now. The Wall Street Journal this morning is reporting that Novelis says they could be open again as soon as the summer. What does that imply for Ford?
Sure, yeah, that's in line with the company's commentary as well. That should mean that we should see a recovery in volume and over time, some of the mitigation of the incremental cost that Ford is incurring today to keep up on volumes. The company lost about 100,000 units of some of their most profitable vehicles last year because of the disruption. That also created, as you pointed out, some noise in Q4. That recovery really will take place this year, and then next year should have additional recovery from the non-repeat of some of the transitory costs that they're incurring today. So the overall impact on a net basis in 2026 will be positive $1 billion, and there should be further tailwinds going forward for the F-150. And of course, pickup truck demand also remains quite strong, which is encouraging overall for the program.
And on that front, Itai, I'm curious about some of the regulatory changes that we've seen from this administration vis-a-vis electric vehicles versus traditional gas-powered vehicles. How is Ford communicating that it's going to be changing its strategy, if at all, in terms of production? And then what is that going to mean for the business?
Absolutely. There's been puts and takes. Of course, you saw the significant EV charges that were taken last month or in December. But going forward, we see significant tailwinds from a number of fronts. First, the ability to sell a richer mix of vehicles. That could be more Raptor trims, more pickup trucks. And Ford did call that out last night as a tailwind, including in 2026. There's also a reduction in actual compliance costs going forward. That could be several $100 million this year. And over time, there could be even additional R&D benefits that the company could record too. So net, we think it's a multi-billion-dollar opportunity over a number of years from an earnings tailwind perspective, though of course it did lead to restructuring in the near term, including some significant supplier payments that will impact the company's cash flow generation this year. But overall, we think that shifting regulations is a tailwind for Ford and some of the other automakers in the U.S. as well.
At the same time, Ford is saying about 3 more years of electric vehicle-related losses are to come. Is that a surprise at all? And is there any potential upside from that it actually isn't that long?
Yeah, no real surprises there, but it's a great point to bring up because the company is not moving completely away from electric vehicles. They're still investing in the next generation platform that will launch next year with about a $30,000 mid-size electric pickup truck. We are actually still constructive on the EV demand in the U.S. over the next couple of years. And so what you saw in the restructuring charges were a lot of just the Gen 1 platforms and just some of the shifting that has to happen in the near term. And that is, of course, costly, but Ford still is investing quite a bit invested in the next generation EVs, and that will help drive them towards profitability kind of later in the decade, or at least kind of a break-even point at that point in time. And a lot of the lessons learned from the first generations of EVs are being applied to the second generation, which will launch next year. So they're kind of at a point now where they can enjoy some of the flexibility from the easing emissions regulations, a lot of tailwinds there, while kind of learning lessons from the past and taking their time to invest in the next generation of more affordable and better EVs, which could be well timed, frankly, with what we think will be an eventual recovery in EV demand. And those two things combined should help the company kind of achieve that 8% target in 2029.
Itai, your tone sounds pretty positive on the company, but I think you still have a hold rating, if I'm not mistaken. So I'm curious what would change your mind on that. And I also wonder how much it has to do with the rally that we've already seen in the shares over the last year. They're up about 40%.
Exactly. Yeah, the stock is fairly near our target of $15. We have been more constructive on the U.S. OEMs, particularly since last summer when the emissions regulations began to shift pretty rapidly. What we want to see, I think, going forward is still continued cost execution. As you mentioned, there's still a lot of noise in the numbers. The first half will be a little bit softer than second half, partly due to the Novelis kind of recovery. So we kind of want to see a bit more execution going forward. But we were encouraged by what we saw last night, including the company putting out this 2029 margin target, which we thought was encouraging, because this is actually a really unique time for automaker stocks, where because of some of the tailwinds we are seeing in emissions and because of some of the strength in U.S. auto demand, it's great to kind of see the automakers kind of get back into giving us multi-year margin and the financial targets, because we think that now is a good time for investors to really take a deeper look into those targets, given the amount of growth that these automakers could have. So we want to see a bit more execution, but again, pretty encouraged by what we saw last night.
Itai, great to see you. Thanks so much.
Thank you.
The economy is off to a strong start this year, with U.S. payrolls rising in January by the most in more than a year, and the unemployment rate unexpectedly falling. We'll send it over now to Yahoo Finance's Jennifer Schonberger for an exclusive interview with the U.S. Labor Secretary. Hi, Jen.
Good morning, Julie. That's right. I'm joined by Labor Secretary Lori Chavez de Reamer. Madam Secretary, thank you so much for joining me. It's great to see you.
Oh, good to see you too. It's been a while.
It has been a while. It's nice to have you back on the program. Payrolls coming in just about double expectations. The unemployment rate surprisingly dropping. Labor force participation also up. So seemingly a strong report across the board. But when we look at where the lion's share of the job growth was coming from, it looked like, again, it was coming from healthcare, social assistance. A lot of economists have told me if we were to take those sectors out, job growth would be a lot lower. Why do you think we're not seeing stronger job growth across more sectors in this economy?
Well, you kind of mention it, a surprise. I don't call it a surprise. I call it an investment in America's workforce, and the president has done exactly that. 130,000 new jobs added. Again, I've said this before on this when I visit with you, blown it out of the water. People say their expectations, well, we were surprised. But, really, when I think about it, we've added construction jobs are up, manufacturing jobs are up, and that's been a testament to the investments of $18 trillion that the president has negotiated and brought back to the American people and the American economy. I've mentioned I have been on the road. I'm going to visit my 48th state tomorrow. Out of the 50-state tour, we're seeing the application of what the workforce is being offered by their employees. They're investing in hiring. We are reskilling. We're upskilling. We've been focused on the apprenticeship program. Over 330,000 new apprentices have been registered with the Department of Labor since Trump's Labor Department took office. I mean, when I think about the dedication that we have done on the ground, we're seeing those in those numbers. Yes, we've seen healthcare up, but what we are adding now is those investments, construction of data centers, of semiconductor centers, the auto industry, and then now the manufacturing jobs you'll start to see go up. And as we saw a small jump in this report as well. So we're excited about the private sector jobs. We're excited that the federal government jobs have gone down. Again, a testament to the president's agenda. So do you expect then we're going to see more private sector job growth outside of sectors like healthcare and social assistance here in the coming months? Absolutely. How can we not when that's where we're seeing the investments? That's what I'm seeing on the ground. I was visiting with Semiconductor up in upstate New York, and we're talking $2 billion investment. $250 million of that is going to go to the education of the workforce. We're seeing it in the trades. I was visiting a data center in North Dakota, Fargo, North Dakota. almost 1 million square feet of space. We're seeing hundreds of thousands of workforce in there in construction, and then we'll see the manufacturing jobs happen as well. So we're seeing it on the ground everywhere I go. People are excited. When you talk about the labor force participation rate has gone up, unemployment has gone down, real wages have gone up. So we're seeing the trends, we're seeing more market analysis, and that's positive for the American economy.
We did see benchmark revisions for the last year, 862,000 fewer jobs added than thought in the economy. And earlier this week, National Economic Council Director Kevin Hassett warned that we should expect to see months of slower, lower job growth because of what's going on with labor force participation and higher productivity. Should we still expect that? Was today an anomaly, or is this, you said you don't think it's a surprise?
Yeah, it's not a surprise that we're seeing the growth. I think when we saw the revisions happen, it's what we expected. It's what we talked about when we talk about the benchmarks. When you think about the Biden administration and what the hole this administration was in, we are having to get ourselves out of that hole and then grow forward. So we saw very small revisions in the last 2 months. Again, 615,000 new jobs have been added under the Trump administration. That's positive for the American economy.
But is Hassett right? Do you expect to see slower growth?
Well, I think what we're going to see when we're talking about the birth rate and we're talking about immigration, 50,000 new jobs a month is going to be the new normal. And we blew that again, 130,000 jobs. So productivity boom is on the horizon. You're hearing all the reporting. And again, the economists got it wrong. I think we saw 2 get it right this month, but out of every other month, the economists are getting it wrong. And then you know who is getting it right? President Trump.
You brought up AI because a lot of people have said that that's going to be a driving factor for productivity. But I do want to ask you about the impact of AI on the job market, because Anthropic's CEO, Dario Amodei, was out recently saying that, quote, AI isn't a substitute for specific human jobs, but rather a general labor substitute for humans. He says he thinks AI could lead to a world of less labor-intensive companies. Meanwhile, Yale predicting that white-collar workers could be displaced by AI. What is your response to these two? What impact do you see AI having on the job market?
Well, certainly fear-mongering is not what we do here at the Department of Labor. We don't create the market demands, but we answer the market demands with the workforce. Again, what I've been seeing is the confidence that these employers have on how AI is going to assist them in streamlining and efficiency. But it's not to replace the American worker. One of the things the Department of Labor is doing is we want to measure that economic data points that come back. So we have launched the AI Hub here at the Department of Labor, where we can collect the data from the free market to see, are we hitting the targets? Because the excitement on the ground is we're using AI to assist the American worker, not replace them. So I am excited about it. I sit on the AI task force for this administration to make sure that we are dedicating resources to be proficient and literate in AI for our future workforce. We're getting those grant dollars out to the states. We're working with our state partners so they can have it enhanced so that we can make sure that we're answering the call. Because I can tell you this, somebody's going to capture the benefits of AI. We want the United States of America to be the one to capture those benefits. So the name of the game is we need to be AI dominant. The president has been clear, and the Department of Labor is doing all the work they can do so that we can protect the American worker, keep their jobs. And we have seen an inversion, right? People thought that maybe the blue-collar workforce would be displaced by AI. It's really been an inversion. The dirty jobs. We see Micro talking about it often. I've sat with Micro at Ford company in Michigan to talk about this. And I can tell you what we're excited about is that we need more construction. We need manufacturing. We need operators. We need machinists. We need electricians. That's an exciting part. Mortgage paying jobs. We're training the workforce. AI is not going to displace that. It's only going to assist the American worker.
Madam Secretary, I do need to ask you, there are some reports floating out there about an Inspector General's investigation into whether your chief of staff and his deputy engaged in what is being called travel fraud. Is this true? Can you provide any comment on this?
Well, I think what's important today is to talk about the jobs report. Everybody has their job to do. What I'm here at the Department of Labor to do is focus on the men and women of this country who every day we show up here, the Department of Labor shows up here to protect the American worker, making sure that they have the skills and education. We're going to keep moving forward on the president's agenda, and it's great to be part of his team.
Madam Secretary, thank you so much for your insights.
Of course.
Appreciate it.
Thank you so much.
Great to see you.
Yeah.
Julie, I'll send it back to you in New York.
Thanks, Jen. Appreciate it. Coming up, Lyft is reporting disappointing fourth quarter revenue and weaker than expected first quarter guidance. We'll talk to the CEO, David Risher, next on Market Catalysts. Lyft shares are sharply lower after it issued disappointing fourth quarter results with revenue missing estimates, despite it being the company's most profitable quarter ever. The ride-hailing company also forecast a weaker than expected first quarter. And joining me now is David Risher. He is CEO of Lyft. So David, obviously the market not happy with these numbers. And I know you talked on the call a little bit about some unexpected promotional activity and competition in the fourth quarter. Talk me through whether that's where you would point the finger, or are there other things going on here?
Hey, I think that's it. Look, as you say, we had record profits, but I think more importantly, we had record bookings, accelerated bookings, and record cash flow. And we have record active customers. So all of those are really good leading indicators that our service is working, that our customer obsession is driving profitable growth, and so on. And we don't see any weakness in the consumer either. So, I don't know. It's hard to know exactly why people react this way. I think we did see a little promotional kind of skirmishing, kind of back and forth at the end of Q4 with the other guys. But frankly, that's normal. And the fact that we kind of came in both at top and bottom line with strength suggests to me that we're resilient and doing just fine.
At the end of the day, we've had this discussion before. Does a lot of it, and I know that you talk about being really focused on the customer, but at the end of the day, does it really come down to price? That people are just going to charge, or are just going to ride with who they see as cheaper? And if you are really focused on retaining margins, that you could potentially be hurt by that?
Here's how I would think about it. So let's look at it from a rider's perspective. The best way to save money, if that's what you want to do, and to be clear, not everyone focuses on that. Some people want United points. Some people want to be part of Lyft Teen. But the best way to save money is actually to check both apps. That's absolutely true. But it's not because we're going to try to necessarily undercut each other on price. Frankly, both of us price competitively. The reason is simply that sometimes you'll get a little better price on one, sometimes you get a little better price on the other. People save, I think, $170 a year who actually check both apps all the time. So that's what's kind of interesting to me is we actually are in a stable industry. If people check both apps, they're going to do just fine, and both companies are going to do just fine because our market is so underpenetrated. So I think the kind of price skirmishing, these things kind of happen, but I think they're kind of small potatoes compared to the big picture, which is there's a lot of growth left in this market.
So talk to me about the remainder of the year then, because I know that you're talking about first quarter EBITDA margin being in line with what you saw in last year's first quarter, but then for the full year, I believe you're holding steady with your margin guide. So where does that pickup come from after the first quarter?
Yeah, for sure. So what we see generally is first quarter is always a little bit softer in certain ways, and then it kind of tends to grow through the course of the year. If you look at our mix of operations, so everything from standard rideshare to luxury, the high-end modes and so forth, it's actually in some of the higher-end modes that things are growing even more quickly. We've doubled our high-end modes year on year, and that tends to have a little bit better margins. Same as we build our ad business, that's going to have higher margins. So I think a lot of the sort of margin work that we've been doing for year after year after year, it's only going to accelerate through the course of this year. But again, if I look sort of big picture, we had record top line, but also record margins, even in this past Q4. So, growing up, I think by 27% year on year or something like that. So I think we've got a pretty good track record of building margin. I think investors would always like to see faster progress, fair enough, but we're very much on that path.
David, let's talk about autonomy, which I know is a big topic right now. You guys partnering with autonomous companies like Waymo. And I guess the same question sort of goes for that as would go for regular people-driven cars now, which is, if I'm getting a Waymo car, what's the difference then in the two experiences, depending on how I book that Waymo?
Yeah, I know what you mean. So autonomous vehicles are definitely coming, right? Self-driving cars are going to be a bigger and bigger part of the mix. And we think that's great. And the reason we think it's great is because what we find is when self-driving cars enter the marketplace, the market tends to expand. And you can understand why that would be, right? It's a new product, and it's a cool product. It works really well. It's quite safe. You can have a private conversation in the car and so forth. So that's really good. So our strategy has to be to bring those self-driving cars onto our platform. And once they're on the platform, frankly, that's differentiated from the past, for sure. You couldn't get a self-driving car in the past. But then you're absolutely right. Then the trick is, how do you make sure you have the absolute best service possible? And what I think you can do is you can have what we call a great hybrid network. You can get a self-driving car, you can get a human-driven car. That's how you're going to be picked up the fastest. That's how you're going to get the best service. On average, you can get health in your luggage if you want that. Be a self-driving car if you want that. So I think it'll kind of expand the marketplace and give new options. And I think our job, of course, is then to provide the best service we possibly can.
What's the pricing going to look like on a self-driving car in a particular market versus a human-driven one?
Yeah. What we see right now is that the pricing is very similar. In some cases, it's actually even a little bit higher, which is kind of interesting. But you can understand it. It's a little bit of a premium product right now. I think what's interesting from an industry perspective, and this is kind of behind the scenes stuff, is we believe the cost to operate self-driving cars might be 10 to 20% less than today's cost. And then Lyft, because of FlexDrive and some other things that we've got that I'll go into another time, we think we can do an additional 4 or 5 points above that in terms of cost efficiency. So I think the costs are going to be lower, but I think you're going to find that the prices remain fairly stable. Again, it's going to be a fairly niche product for a while, and I think kind of a high-end product for at least, kind of the foreseeable future.
Speaking of maybe another niche product, you guys are rolling out a teen service. I got to be honest with you, David. I got Uber Teen for my 16-year-old because it existed and Lyft Teen did not exist, right? So how do you switch over customers like me, or how do you pick up new customers who were already familiar with that product?
Yeah, fair enough. So, I mean, in a sense, the good news is there's something like 40 million teens in the United States, and every single year there are 4 million more teens, people who turn 13. So the good news is it's kind of this infinitely, replenishing resource of teens, all of whom want the same thing. They all want independence. They all want to get out of the house. And frankly, parents are pretty busy. And this is a good way to save money, by the way. Think of the insurance. Maybe you know this yourself. You put your kid on your car insurance. It's going to cost you a couple $1,000 a year. That's a couple hundred Lyft rides you can take. Look, my way to convince you is just to say, give us a try and see which one you like better. I think the team has done an amazing job really getting, in particular, the communication between driver and parent, which a lot of parents talk about being really important. They want to know who that driver is. We're putting the absolute, highest quality driver on this program we possibly can. But in any case, I think to a certain extent, the choice will be people's, and we'll kind of see how it plays out. But I'm super excited. It's off to a great start.
Challenge accepted, David. I'll take a look at that and see how it compares.
Please.
Thank you so much. It's great to see you.
Yeah, it's great to see you as well. Thanks so much for your interest and questions.
Thanks. Coming up, the top analyst calls on Wall Street. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Zillow, Spotify, and Marriott. First up, Zillow. Multiple firms lowered their price target on the company, including Deutsche Bank, Piper Sandler, Cantor Fitzgerald, and JP Morgan. This comes after the home search site now faces legal challenges that led to higher expenses in 2026. The current 12-month average price target on the street is $76. Next up, let's take a look at Spotify because Bank of America cut its price target on the streaming service to $7.50. The analyst said this new price target better reflects the current environment. The analyst also said by leaning into personalization, product innovation, and scale, Spotify is positioned to use AI to strengthen its platform. The 12-month average price target is $668 on the street. Lastly, let's take a look at Marriott because Mizuho raised its price target on the stock to $343. Deutsche Bank also raised its price target on the stock to $348. And the analyst at Mizuho, Ben Chaikin, cited the hotel chain pointing to strong consumer spending and a step up in royalty rate paid by the card companies. The average 12-month price target on the street is now at $352. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout today's trading session.
Bonds are falling today as traders pare back bets on Fed rate cuts following a better than expected jobs report. That is, prices down, yields up. Joining us for more, Cooper Howard, Schwab Center for Financial Research fixed income strategist. So we are seeing those yields move higher in the wake of the better than expected jobs report. And, basically this seems to imply people already didn't seem to be expecting a Federal Reserve rate cut in the next couple of months, but now they seem to be pushing it further out.
Yeah, that's definitely the narrative that's coming out of this labor market report, is a shift back in the number of rate cuts and a later than expected rate cut. So our view is that we're still expecting 2 rate cuts this year. It's largely going to be dependent upon how the economy develops. But the strength in today's gains, I think if you look at the report itself, just in isolation, it was a very strong report. It was very difficult to find any sort of a blemish with it. Unemployment rate down, the number of job gains was much more than expected, nearly double than what was expected. So I think in isolation, the single report is a positive. But if we look back at what has happened, that shows a little bit of a different picture. So revisions were much worse than expected, subtracting nearly 900,000 jobs over the past 12 months. It shows that the number of gains has been relatively slow. I think that confirms a lot of what many analysts had expected, is that we were in a relatively weak labor market. So in terms of what that implies for the Fed going forward, I think what we'll have to look is, how does the labor market continue to carry forward? So 1 month doesn't necessarily make a trend. If we see further weakness, or if we see, further gains in the number of jobs, then I would expect that probably shifts the narrative to fewer than 2 rate cuts, as we're currently pricing into the market right now. The other thing is, inflation still remains above the Fed's 2% target. It has remained above the Fed's 2% target for nearly 5 years. So that really puts a floor on how aggressively the Fed can cut going forward.
Well, and of course, it's a weird week because we get jobs on Wednesday and CPI on Friday. So consumer inflation is going to be the other piece of the puzzle here. And do you think it's sort of going to confirm that heat that we saw in today's jobs report? Or do you think it confirms the sort of disinflationary trend that we have been gradually seeing-ish?
Yeah, so far we've really seen sticky inflation, and I don't expect that narrative is going to shift anytime soon. We should continue to see that. If we look at the labor market report, most of the gains were in the services sector. That's also where we're seeing some of the inflation side of things, more on the good side, I should say. And there's a lot of kind of also the tariff narrative that's playing into effect here. How much is that influencing higher prices, and how long is that going to be in effect to where we don't see inflation shift back down to that 2% target?
So what does all of this then end up meaning for rates, right? For this year, do we see yields kind of stickier at a higher level?
You know, I do think that we see longer term yields being stickier at a higher level, Julie. A couple reasons for that is, if we break down the composition of, say, the 10-year U.S. Treasury yield, you can break it down into expectations for the Fed fund rate, inflation expectations, and then this kind of catch-all that we call the term premium in the fixed income markets. And really, that's just the compensation for the unknown, or the compensation for uncertainty that's out there. And my colleague Liz Ann Saunders really likes to use a good term called the instability that we're seeing. Not necessarily the instability, not necessarily the uncertainty, because the future is always uncertain.
Sure.
We're seeing a lot of instability in the market right now, whether it's concerns over the federal funds rate, higher debt levels at the federal side, concerns over what's happening on the federal side of things. And that should really keep that term premium elevated going forward, and therefore probably put a floor on how much lower longer term yields could potentially go.
So, and this is something, a theme we've explored before, so that could mean even if we see the Fed continuing to cut rates, for example, mortgage rates might not come down and stimulate the housing market.
Exactly, and that's something that we have a lot of conversations with many of our investors, and the differences between short-term interest rates and longer-term interest rates. And it tends to be that mortgage rates are priced off of longer-term interest rates, so the 10-year Treasury, for example. So if the Fed does continue to cut interest rates, and like we mentioned earlier, we are in the camp of they are going to continue to cut rates this year, that should pull the short end of the yield curve lower, and we expect it to steepen the yield curve, meaning that short-term rates move down lower than longer-term rates. But in terms of where ultimately mortgage rates could go, that's more of a narrative of what's going to happen with longer term rates. And we do think that it doesn't look like there's too much more downside with where we could go with longer term rates in this market.
Gotcha. Not great news then for people wanting to buy homes. Thanks so much for coming in, Cooper. Appreciate it.
Thank you, Julie.
Take care. Coming up, Alphabet's 100-year bond sale explained. Jared Blickery takes you through it in today's Stocks in Translation next.
Yes, Google's parent company Alphabet is just tapping the bond market with a 100-year time frame. No joke, this bond is not going to mature until the year 2126. And the wild part is investors could not get enough of it. On today's Stocks in Translation, we're breaking down what this so-called century bond actually is and why a company that's drowning in cash, why they would want to borrow in the first place. So Alphabet is raising about $32 billion across multiple bond deals in multiple currencies, and only a smallish part, 1 billion British pounds, is for 100 years. But let's back up a minute and add some context about the difference between stocks and bonds. So stocks are ownership. Bonds are a loan. With a stock, you own a slice of the company. You buy it with the hope that the stock price goes up, and maybe the company pays you a dividend. With a bond, you're lending to the company money, and they pay you interest until the maturity date is reached, and then they pay you back the original amount, and you get to keep all the interest. Now let's talk about who buys something like this. Some buyers, like pension funds and insurers, want steady payments for a very long time. Their promises to pay people last decades. So guess what? They like investments that last decades. Other buyers are just making a big clean bet on interest rates, hoping to buy low and sell high, or vice versa. And why would Google's parent company want to go into debt when they're neck deep in cash anyway? Because AI is turning tech into a hugely expensive infrastructure build out, and even cash-rich companies like to have cheap, flexible funding while rates are historically low. Okay, so quick history break right now, because century bonds, they are not anything new. Way back in 1993, Coca-Cola did a 100-year bond. And so did Motorola in 1997, which was the last time a tech company played the century game. The government of Austria, they also sold one in 2017. And if you really want to melt your brain, the UK issued perpetual bonds called consols starting in 1751 with no maturity date ever. So here's the thing to really wrap your head around. It might not come right away, but if you can get this straight, you can talk bonds all day with the best of them. And what I'm talking about is how a bond's price and its yield always move opposite each other. Let's use Austria's 100-year bond going back to its start in 2017. We've got the bond price in white and the interest rate in green. So notice the mirror image. In fact, that's the only thing that you really need to concentrate on. When the price line goes up, the yield goes down. And when the price goes down, the yield goes up. This is a seesaw. And here's why this happens like clockwork. Let's say a new bond is issued at a certain interest rate, maybe 5%, and with a maturity of 10 years. Then let's say other 10-year bonds are issued with higher rates, like all the way up to 10%. Well, our original bond that's only paying 5%, while these others are paying 10%, they don't look that attractive. So the price of the bond starts getting cut until buyers feel like they're getting a good deal. A rough rule of thumb is if yields double, then the price of the bond can actually get roughly cut in half. It's not perfectly like that, but that's a very good starting point. Okay, what do we look out for next when it comes to big tech and big bond offerings? First, we want to watch demand on similar long-term tech bond offerings. Are these deals getting upsized or are they getting cut? Then there's pricing. Is the extra yield that investors are demanding beyond safe government bonds, is that shrinking or is it growing? And then there's a narrative. Does AI stay in build-out mode, or do we start seeing AI turn into real revenue? That answer can determine who wins in both the stock and bond markets. And remember that the pick and shovels trade of the dot-com boom, which was a huge build-out of fiber optics, those cash-rich giants didn't get the huge upside, but they did share in the long, deep downside. Something to think about with Alphabet. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
The S&P 500 is trading close to a record high, but volatility has been ticking up as well. Investors are navigating the choppiness, of course, through ETFs. They continue to see strong inflows. According to ETF.com, U.S. equity ETFs brought in $11 billion in net inflows in the first week of February. Let's talk to Jay Jacobs about it. He's BlackRock U.S. head of equity ETFs for this week's ETF report brought to you by Invesco QQQ. Good to see you, Jay, as always. Obviously, it has been a very interesting market thus far this year. There has been rotation. There's been a lot of headline risk seemingly. And then this morning we got a jobs report that came out well ahead of estimates. How have you seen this sort of play out as we've had sort of these waves of selling, particularly in technology?
Well, we've seen just a tremendous amount of use of ETFs as precision instruments to get exposure to some of the more interesting areas of the economy. Earlier in January, we saw a lot of flows into emerging market ETFs like EEM. We saw a lot of interest in small caps when we saw a bit of a rotation from growth to value into funds like IWM. We've seen mining stocks, we've seen silver, we've seen AI, software. So many niche parts of the market get a ton of attention from investors who are looking to express a view on these corners of the market, which at the end of the day is what ETFs are tremendously useful to accomplish.
Yeah, it's been really interesting to see all of those trades that had sort of been out of favor, although obviously we know international started to come into favor last year, but it's been interesting to see small caps, for example, finally catch a bid that some people have been looking for a long time. Again, when you look at the sort of less loved places in the market, like a software area in the market, what kind of activity have you been watching there?
Well, we've seen a huge amount of trade volume on IGV, which is our software ETF. You've seen a lot of options trading on it as well. I think at the end of the day, it's just there's a lot of opinions on this space. You have some people who have said, AI is going to disrupt a lot of the SaaS marketplace. You have others that are saying this is a buy the dip opportunity. SaaS has done so well for so many years. This is a time to get in a lower entry point. Our view is probably more nuanced than that. We've seen some of our active managers like Tony Kim, who manages our active AI fund, BAI, really try to sift through this space and understand who might be the winners versus who might be disrupted from artificial intelligence in software. But importantly, ETFs give people a tremendous way to express a view on the space.
And this year we've also seen, it hasn't been a perfect rotation, certainly into cyclicals and out of into other kinds of cyclicals, I guess, because you could argue tech is cyclical too. But energy, materials have performed well. Have we seen that reflected in ETF activity as well? And is there anything that sort of has surprised you?
Certainly on the material side. So we've seen a tremendous amount of interest in things like natural resources miners with PIC, our ETF PICK. We've seen it with ICOP, which is a copper mining ETF, as well as a Ring, which is a gold mining ETF. There's been a lot of investors who are looking towards the mining space as a way to pick up some inflation protection with metals, but also some of the long-term, more thematic ways of playing metals in areas like if we see more geopolitical risk with gold, or frankly, looking at things like AI and the build out of data centers, which is we're going to require a lot of silver and copper.
And you guys, by the way, speaking of AI, you guys do have a big AI ETF called BAI that has over $8 billion in assets. I was just looking at the price return this year, and it is up about 4%. So, there is this implication, like it's not like people are abandoning this trade wholesale. What have you been seeing in terms of activity there?
No, not at all. I mean, we've seen tremendous interest in the space. We continue to see inflows into BAI as well as RD, which is our index-based ETF for the AI space. The answer is it's more nuanced. We're seeing some parts of the market struggle, but frankly, a lot of those names in the SaaS space are not owned by AI funds. We've been saying for a while, software could benefit or be at risk of AI. Companies could benefit from being able to deliver more software with the same amount of engineers, would be helpful for margins, or their software could be disrupted by someone who can program a competitor in a few minutes using artificial intelligence. So it's more nuanced than that. I think what we're seeing in the AI space today is still a lot of conviction in the trade more broadly. And we're also seeing interest in areas like semiconductors, where memory chips become one of the more fast-growing themes as well in the market. So this really speaks to the value of being diversified across the AI value chain with a fund like BAI.
And Jay, lastly, I do want to ask you about IBIT, which is the biggest Bitcoin ETF. I'm actually going to catch up with your colleague, Robbie Menchenick, tomorrow at a Bitcoin conference. But since you're here with me, I did want to ask you about that one as well, because as the biggest Bitcoin ETF, it's down with Bitcoin, as you might expect. And I'm curious what you're hearing in terms of sort of sentiment around that product, which came out with such a bang when all of those were approved.
Well, we're seeing a tremendous amount of volume in the product, which to me just suggests there's a lot of opinions on Bitcoin, similar to what we were saying about software. There's people who see this as a buy the dip opportunity. There's some people who are seeing this as a time where they want to reduce their exposure. We're also seeing a lot of options activity on IBIT as well for people who are playing more nuanced trades, whether it's to get income or do protective collars, et cetera. So I think the important takeaway is IBIT continues to be the way for people to express a view on the Bitcoin asset. And where it goes from here, time will tell. I think importantly, the educational process that we kicked off 2 years ago with the launch of IBIT and speaking with end investors and speaking with financial advisors and institutions, that continues to progress. And I think Bitcoin has always had volatility in its history. This is another bout of it, and that's part of the educational process for some newer to crypto investors.
You're not going to give me a price target, Jay? I'm kidding. I joke. It's good to see you. Thanks a lot for joining us. Appreciate it.
Thanks for having me.
Take care. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.